Mozart Inc.'s 98,000 taxable income for 2000 X1 will be taxed at the 21% corporate tax rate. For tax purposes, its depreciation expense exceeded depreciation used for financial reporting purposes by 27,000. You see, I'm reading here. Now, they have 45,000 of purchased goodwill on its books, and during 2000 X1, the company determined that the goodwill had suffered a 3,000 impairment of value for financial reporting purposes. Now, none of the goodwill impairment is deductible for tax purposes. Mozart purchased a 3-year corporate liability insurance policy on July 1 of 2000 X1 for $36,000 in cash. The entire premium was deducted for tax purposes in 2000 X1. So first, let's determine what Mozart's pre-tax book income was for 2000 X1. Okay, so here's the logic that you have to use to determine the pre-tax book income, right? They gave us $152,000, right? Pre-tax book income of $152,000. So what you have to do is work backwards. They gave you $98,000, and then we start working backwards. The insurance expense deducted for tax purposes before financial statement recognition is $30,000. Okay? The tax depreciation in excess of book depreciation was $27,000. Okay? They gave us that. So if we work backwards, we come up with $155,000, and then we have to consider that there was a $3,000 impairment for financial reporting purposes. So that would get us to a book tax or a pre-tax book income of $152,000. Keep in mind that you have to prorate the 3-year corporate tax liability policy, right? They purchased it on July 1. It goes 3 years. So we're not going to recognize it. You're not going to recognize the full $36,000 that incurred in cash. You have to work through that, and that's why the dollars are different. Next, we want to determine the changes in Mozart's deferred tax amounts for 2000 X1. So if we get rid of this, we can see that what we do is we identify the temporary differences, right? Because the tax rate didn't change in 2000 X1, the increase in the deferred tax liability is equal to the temporary difference during arising during the times of the tax rate. So we've got the excess depreciation, which is a future taxable amount. We have the insurance expense, which is also a future taxable amount. Those are $57,000. The rate didn't change, so 21% is the proper amount. So the increase in the deferred tax liability would be the $11,970 you see right there. And finally, we need to calculate the tax expense for 2000 X1. So we know they gave us taxes due of $98,000. The tax rate is 21%. We start off with $20,580 owed, but then we have to add to that the increase in the deferred taxes, which we just calculated is $11,970. So those two amounts would become the tax expense that we would show in the financial statements for financial reporting purposes.